participants in the foreign exchange market. Now, the Forex market is the largest of all financial markets. It's the most liquid and heavily traded market in the planet, outstripping all other markets with an average trading volume of about $7.5 trillion per day. And that is according to the Bank of International Settlement report that was published in 2022. So every 3 years, the BIS, which mainly deals with settlement of FX trades, gives us a report, and that is where we get the data of the daily market turnover. So several factors contribute to this big turnover that is available in the FX market, starting with the fact that this market is open 24 hours a day, 5 days a week, which is contrary to any other market. At least for now, we have the crypto market, which is open 24 hours, 7 days, but the daily turnover, the participants are not as many as the ones that in the Forex market. So this market is highly dominated by banks. And these banks are the ones who quote the exchange rates, which are the buying price and selling price for these different currencies. Main locations for the FX markets, uh, as we discussed on the previous section, London is located within the Asian time zone and the New York time zone, so it takes advantage of this market. So it carries out a lot of transactions. Therefore, 37% of our transactions involving FX are done in UK. And the US has 19%, Singapore 8%, Hong Kong 7%, Japan 6%. Others fall into the 23%. So FX trading in the African countries has been slowly developing, with mostly we have retail traders and interbank trading. So these are the market participants of the foreign exchange market. So we have the central banks, we have the international banks, we have international investors, we have day traders, multinational corporations, we have domestic corporations, we have private investors, but also tourists. The international banks are the main participants in the foreign exchange markets. They are the dominant here. They carry out 63% of the market volume. They also provide trading venue and platform. They are also there to facilitate FX needs for customers and take on FX positions for themselves and sometimes on behalf of their customers. Central banks, on the other hand, these basically regulate the international banks, regulate other banks, and affect the FX market through its policies. Sometimes they intervene in the Forex markets by taking trades in the Forex market in order to adjust the exchange rate of their domestic currency. So, for example, here in Tanzania, just last month, we had central bank intervening in the Forex market, and they took trade based on the dollar, and the volume was around $60 million. So they intervened in order to adjust for the to stabilize the Tanzanian shillings value against the dollar. And we also have international investors who invest in other countries. They will need to participate in foreign exchange market in order to get the best rates to convert their foreign currency into the domestic currencies. We also have day traders, those who take advantage of the price difference between now and the future and speculate on that and bet on that to gain profit. So day traders. We also have multinational corporations. These are the ones that participate perhaps in commodity trading, which affect commodity currencies. They also invest in other nations, so they'll need to convert one currency to another. They also participate in the foreign exchange market as investors. We also have domestic operations that are within the local domestic range. And these are the ones who maybe do exports or imports, so they will need to participate in the foreign exchange market by converting one currency to another. We also have the private investors, high net worth individuals who take on their own trades. Sometimes these private investors would go to invest in other countries, so they'll need to do the FX transactions. We also have tourists. Tourists also purchase foreign currency when traveling abroad, so they can use either cash or either MasterCard. So all these are transactions that involve FX. So these individual transactions are usually aggregated by the card issued bank and transacted in the foreign exchange market. So these are all participants in the foreign exchange market. Now, all these market participants can be classified into two distinct groups. We have the interbank group and the retail group. So the interbank groups are mainly central banks and the international banks, which we categorize them as the sell side liquidity. These are the ones who sell to the retail customers, which are the international investors, the multinational corporation, all this, the domestic corporation, day traders, tourists, and specialized brokers. So these are the buy side, and we fall into these participants. So according to statistics, the market participants' participation size falls into four key segments. We have the domestic and international banks carrying out 63% of the transactions, so they are the largest in size as market participants. We have the central bank, which intervene to support or suppress the value of its domestic currency. We also have the corporates, which carry out 7% of the transactions. They need to pay invoices, they need to hedge for their exposures. So they use hedging as a strategy to reduce their costs. And even they enter into, we have four transactions, which we are going to talk about it later on. And we have the speculators and investors. These are high net worth individuals. We have hedge funds, proprietary trading desks that are available in big countries which are highly participating in the Forex markets, for example, in the UK, the US, and Japan. So they carry out 21%. Yeah. So all these market participants have an interconnectedness in the foreign exchange market. So you can see here, foreign exchange transactions flow from the retail sector to institutions like the international banks. And these international banks are the one which are operating in the interbank market. And all these are supported by the foreign exchange platforms and regulations that ensure that there is smooth operation of the foreign exchange market. So you can see how the interconnectedness of all these market participants work. And this is the market that we are dealing with. This is the market that we are trading.